What's the market reaction telling you about what this means now?
We had two catalysts to defeat the seasonal weakness this week, and we're 0 for 2. It's still a sell the rips market. Chairman Powell did nothing more than read me yesterday's newspaper. The market had already priced in exactly what he said. The market realizes that the risk is that the economy stays longer than the Federal Reserve is comfortable with, and that they're going to have to raise rates further.
So
that's what the Treasury market has been telling us.
So you're hanging on the persistent signs of above-trend growth could put progress on inflation at risk and warrant further tightening. Those are the words that you think matter more than anything to the market right now.
Well, that's what's mattered to the market in the last 3 weeks, and he's just reiterating that.
Okay.
Quite candidly, I think he's wrong. I think he's a classic example of a trader who is right, but early. I think that the inflation is going to ultimately prove to be transitory. We've got $1 trillion of fiscal stimulus that will begin to fade out. You have disinflation in China and in Asia that is ultimately going to be exported here. I think inflation is going to come down. I just don't think it's going to come down fast enough, and he's going to be doing a little bit too much.
Okay, so the read, Jim, on the chair was that he was more hawkish than not. I'm not trying to just be an automatic contrarian or anything, but I was hanging on the lines a little bit, uncertain about the lags.
Yep.
He said might be, quote, significant further drag in the pipeline. To me, that sounded like somebody who was looking at a bar that was kind of high to doing more, like concerned about what sort of lags have yet to be felt. I don't know if we should be focusing on that a little bit more than perhaps some are.
I will agree with you that he was, I'd call him hawkish. I don't think, he wasn't dovish. Certainly no talk about cuts, right? There shouldn't have been, and there wasn't.
Maybe it was just neutral.
Good. Yes. Okay. And the reason he's neutral is because he's saying, look, last year he punched the market in the face. This year he's saying, I'll do it again, but I'm going to wait and see what the data comes in and tells me. He says, we're ready to raise rates. Going to wait and see what the inflation data does. 2 months isn't enough. Also acknowledged again the long and variable lags. Doesn't know where R star is. Nobody knows where R star is. It's not something, you look up on the Wall Street Journal front page. So he's acknowledging, he did this at least twice. He acknowledges there are risks out there, and they're going to be very careful with how they proceed. Not changing the inflation target. That's silly. That was not going to happen. That's not a one-man decision.
Oh, he underscored 2%, right?
Yeah.
I mean, what is he going to say anyway?
No, he can't make that change on his own anyway. And if they were going to make it, you hear a lot of people saying it. So that was off the table. Look, ultimately, just simplify this, data dependent. So, Joe, to what you were saying, I agree with you. I think inflation is going to come down. On that note, last thing, he did acknowledge the lagging effect of rents in the stated CPI numbers. I think that's important. He knows that.
Rob, so Joe referenced 0 for 2. I know what he means. The first one's clearly NVIDIA, right? They knocked the cover off the ball yet again. They round the bases, and we think, okay, the market's going to react positively to that. Didn't really. It's kind of muted, actually. And now you got Powell. The market's not sure really what to take from all of it. So where does it leave us at a time where the S&P is now down 4.5% from its 52-week high? If we're in a correction, it's been mild and modest to this degree, to this point. What now?
So I think we're in an environment where you had the speech kind of play out this way. Maximum optionality with some hawkishness. So trying to preserve that soft landing narrative. NVIDIA yesterday is really interesting because the traders reacted positively, and then the investors considered, and they decided that it's probably a time to be mindful of risk. You look at what happened with Microsoft. You look at what happened to some of these big names. And that's what happens when you get extended. You are incredibly, from a valuation perspective, you're incredibly vulnerable to disappointment. You're incredibly vulnerable to a change in momentum. You're incredibly vulnerable coming into the seasonal weakness. And I would say that positioning should reflect that, being mindful of price.
I mean, there is talk about, Michael Hartnett, Bank of America, who does their flow show and who puts out some, I think, pretty thoughtful research. They continue to say tech, second half trouble, rather than an era of what he calls new AI rules. Higher for longer, rates and yields will cause pop and bust, sell the last rate hike. So seasonality is not your friend right now.